Hey everybody, Marty Mazzora here. It's Friday the 10th of May 2024. This is your weekly economic update. So, interesting setup remains. We've got really a mixed bag in terms of the data. In our view, it is continuing to deteriorate. Our recession light, so to speak, remains lit. The things that we think kept the economy alive last year, not the least of which being excess savings on consumer bank balances, that, according to one of our strategist team, is essentially gone as of last month, but not everybody agrees. These things are measured by different people in different ways. As you can see here on the scoring of our index, 46 data points, we got pretty close to the line that divides expansion from contractionary conditions, and then we promptly rolled right back over. Again, a couple of points here this last week. I'll talk about some of the inputs. Once again, I'll share with you some highlights from corporate earnings. We're winding up Q1 earnings season, and interesting dynamics there. A lot of that mixed picture comes from those earnings calls. And then we'll take just a really quick look at stocks, the dollar, yields, and gold. So consumer credit data came out this week. Expected to see a monthly change on total consumer debt to go up by about 15 billion. You can see it went up a lot less than that, about 6 billion. So, again, we speak kind of almost intuitively about, how bad it is that consumers are in so much debt. Well, from an economic standpoint, it says something about the strength of the economy when consumers are willing to spend more money on credit cards and so forth. So the decline is not as welcome as you might think. And here, consumer debt as a percentage of GDP isn't historically terrible. Of course, when we look at total credit card debt and so forth, and revolving debt balances, although the year-over-year percent change of debt outstanding doesn't look too ominous, but the totality of all the debt on consumer balance sheets is troubling. However, when you look at income, you look at personal net worth, and you look at the servicing debt relative to that, in the aggregate doesn't look so bad. And that's what people who are remaining bullish on the economy would tell you, that, hey, it looks like a big number, but they're able to service it pretty easily. And I haven't disagreed with that to this point. However, when we look at delinquency rates, that's something I think is a bit troubling. So here's just the overall credit card delinquency rate. And you can see that's on the rise. Obviously, during recessions, you can see that it really tends to ramp up. Didn't get a lot of that here. Of course, folks got a lot of money. This was so unique in terms of the support that consumers got to service debt with. So ordinarily, this ramps up during recession. It actually went down because of the unique dynamics around COVID. So 30 days plus delinquency rate, you can see that's risen a bit here of late. 90 days plus delinquency rate. And then we have the New York Fed Equifax credit card, what they call serious 90-day delinquency rates. And you can see what's been happening there. Serious 90-day delinquency rate on auto loans. And that's troubling as well. And you remember the dynamics around the car business and dealers charging rarity fees. I saw as much as $6,000 to $8,000. You had to pay extra just to get a car. Folks financed those cars. They financed the used cars when they had the stimulus money, and money was easy to come by, and loans were easy to come by. And of course, here we are, 2, 3, 4 years removed, and we have a mess on our hands. Folks are upside down in a lot of these automobiles that they're driving around. So that's beginning to show up. And here, that's something that has our attention. That looks very late cycle to us, pre-recession kind of stuff. Consumer confidence, last week I highlighted the Conference Board's latest, which really kind of fell off a bit of a cliff there. Well, the first reading on April from the University of Michigan really kind of plunged here to about a 6-month low. As for the key details, one-year inflation expectations actually jumped to 3.5% from 3.2%. That's the highest since November of 2023. The 5 to 10-year guess was up 0.1% to 3.1%. Expectations around higher gas prices apparently was quite the factor there. Only 29.6% of those surveyed think their family income will beat inflation over the coming 5 years. That's the lowest since 2012. So there's more to it. But again, we're a consumption-driven economy. So we want to pay attention to what these consumer surveys say. And as we just looked at, we do want to pay attention to consumer balance sheets as well. Initial jobless claims spiked up this week. Ironically, the market rallied in the morning and the pre-market when that news came out. Remember what I've been saying of late based on what the message that is being clearly sent by Fed Chairman Jerome Powell. Weakness in the labor market is going to inspire the Fed to cut interest rates. So the market is keyed on that. I talked about last week how we made that point. Then we had what was a weaker than expected jobs number, and the market rallied hard on Friday. This week, again, we got a pop there. Now, from what I understand, there's huge seasonality in there. There's something about New York students going on break and New York teachers being able to file for unemployment. And according to Bloomberg, that explained this week, but the market wanted to rally anyway on that news. So we'll see in the next week or two if that number stays elevated. If it does, probably good news for stocks for the moment, because anything that says weak economy says accommodative Fed going forward. Caterpillar global sales. This is one of our inputs, believe it or not, and we only get this quarterly now when they announce their earnings. This is troubling. From worldwide, we had quite the fall off in cat sales, right? Of course, this would speak to construction, yada, yada. Asia, big decline. North America went red. Latin America, slight uptick. And then the Europe, Africa, and the Middle East, big downtick, down 29%. So that was the one input that went from neutral to negative that impacted our score here this week. Now, on the flip side, in terms of activity or the price of activity, the Baltic Dry Index captures the cost of goods shipped over the world's oceans. You can see that as a very noisy number, but we've got quite the uptrend here. So that doesn't speak well about inflation going forward, at least in the transportation space, nor does the cost of a container from Shanghai to Los Angeles. We've seen quite the spike up here very recently in that cost as well. And again, to the extent that shipping costs get passed through, that's not the kind of news that the Federal Reserve is looking for. Now, speaking of inflation, next week is big. We get producer price index and we get the consumer price index, and those are going to be watched intently by markets, as are the U.S. retail sales numbers as well. So next week through Wednesday is going to be not small in terms of potentially market-moving data. To the extent that inflation is hot and retail sales are good, then that's going to be a weight on equities. If they come in softer than anticipated, that's going to be a boost to equities. I think it's plain and simple. That's the way stocks are trading for the moment anyway, and there's no reason to think otherwise right here. So it'll be interesting to see what I report to you next week. That consumer staples to discretionary ratio, this is important, looking at sectors and what the market seems to be discounting. Now, it is earnings season, so there's going to be some individual company influence on that. But believe it or not, this year, folks, the stocks of consumer staples companies who sell the things people got to buy if they want to stay alive is outperforming consumer discretionary, the things people buy when they have extra money, by 8.1% this year. Specifically, staples are up 7.7%. By the way, they're in a tie for first place as our biggest sector in our core allocation right now. And consumer discretionary, which is not a big position for us right now, is actually negative on the year. So obviously our core is having a pretty good run here of late. And so that's something that is a red flag. You see this tends to ramp up as the economy weakens, as you might imagine, based on the nature of those companies. So right now, only 15% of our 46 inputs are scoring positive, 43% negative, 42% neutral. So before I get to the technicals, which I'm going to do quickly when I get there, let's leverage Peter Bookvar. He does such a wonderful job highlighting the good and the bad from the earnings calls of the last few days. So on the positive side, ZipRecruiter, and I'm just going to read from his notes, which are just quotes from the earnings call. Again, ZipRecruiter, there are also positive signs emerging as we begin the year. Q1 24 is the first quarter with a sequential increase in quarterly paid employers since 2022 and is a potential indicator of stabilization in the hiring market. While not yet a return to normal seasonality where revenue ramps up from Q1 to Q2, we see this as an early sign that the labor market downturn is potentially reaching a trough. MSG Entertainment, they were asked a question about the consumer spend, and here's their answer. And in terms of softening of consumer spending and demand, and you referenced McDonald's and Starbucks, and they disappointed, we're not really seeing that. Most of our shows continue to sell out. For our fourth quarter shows, we're pacing ahead of the prior year in terms of our sell-through percentages versus where we were at the same point last year. Cheesecake Factory, comp sales and traffic once again meaningfully outperformed the rest of the industry. Of course, they say that underscores the strength of consumer demand for their brand in particular. Uber says demand for the products remains strong. Lyft, total rides grew 23% year over year, reflecting strong demand across use cases. Simon Property, our tourist-oriented properties outperformed the portfolio average in the quarter with a 6% increase in sales. Camden Property Trust signed blended lease rates up 0.6% year over year in April, with a 1.8% fall in signed new lease rates, mostly offset by a 3.4% rise in renewal rates. Their first quarter through March saw blended rental rates down by 0.9%. I'd say that's marginally okay. Okay, so that's it for the featured positive earnings calls. Let's look at some of the negatives. Again, from ZipRecruiter, something that they said that wasn't so positive. Though results were above expectations, discussed in our last earnings call, the labor market industry backdrop has remained challenging through the first few months of 2024. Hiring levels continue to be subdued, and the number of people quitting their jobs also remains low as the big stay persisted in Q1. Now, I've talked to you about quits rates, and when those decline, that says something not so good about the economy. Tech continues to be one of the hardest hit areas of job posting and hiring activity when we look on a year-on-year basis. They go on, but they're also feeling somewhat optimistic going forward, as I read a minute ago. Warby Parker, traffic still hasn't rebounded to what we would have expected at this point. We think about the broader optical category, it still has not returned to normalcy. From Tapestry on North America, it's really a continuation of what we've been seeing in the market. The consumer is being more choiceful, despite some positive factors in the market. Certainly, labor is a positive in the market. We do see consumer confidence is low in North America, likely impacted by sticky inflation. So we are seeing an overall cautious consumer. Dine brands. During the first quarter, like others in our industry, we saw large areas of the country experienced poor weather, impacting sales and traffic. Consumer caution with respect to economic conditions persisted in the post-holiday period. They go on, but I'll stop there. Reynolds Consumer Products, when we reported results in February, I spoke to volume as being under pressure across the consumer staples sector. During the quarter, demand was modestly better than expected in some of our categories, and share gains also contributed to our retail performance. However, factors including reduced consumer savings, increased credit card debt, what did we just talk about, continued inflationary pressure, and elevated interest rates continue to pressure consumption in our categories. Expeditors International, well, we are no longer experiencing anything like the widespread supply chain chaos of the pandemic. Our industry remains volatile due to global conflicts, stubborn inflation, fragile economies, and uncertain demand. Disney, as it relates to demand, while consumers continue to travel in record numbers and we are still seeing healthy demand, we are seeing some evidence of a global moderation from that peak post-COVID travel. From Simon Property, we feel like the malls made a big comeback. Physical stores are where it's happening. We're seeing a resurgence and reinvigoration of that whole product, but the lower income consumer has been under pressure now for quite some time, and we are very focused on that. From Microchip Technology, and this is what we've been hearing from other chip providers here the last few weeks, We experienced a major inventory correction in fiscal 2024, leading to a 9.5% decline in revenue to $7.6 billion. We believe we are under shipping to the end market demand as customers and channel partners continued to reduce inventory. This situation has required us to implement ongoing austerity measures, including taking actions to reduce factory utilization that will persist into the June quarter. Jones Lang LaSalle. The year started with some positive momentum highlighted by an increase in bidders and the closing of several large deals in North America. The green shoots encapsulate investors' willingness to deploy capital when market conditions warrant. However, once inflation data came in higher than expected and the hope for several interest cuts later this year diminished, real estate capital markets became much quieter again. Well, that looks like it in terms of those featured earnings calls. Once again, mixed bag. The economy is a forever moving target. Okay, quickly, let's just look at some technicals. Since I have it up, we'll just look at the hourly chart of the S&P. We're pushing right back up to those all-time high levels. Remember, big data coming out next week. On the hourly anyway, bearish divergences and momentum. So this is definitely highlighting some caution going into next week. On the one-year daily chart, recall that we had a very compelling looking bear flag pattern, and that gap that we saw right there was good old Jerome Powell taking care of the market. We were up at one point during the day, came down, actually closed above the trend line. The bottom of that faint blue candle right there is where the market closed. As for the NASDAQ 100 or the ETF that tracks it, you can see we're right up here. Nice move here. This is the hourly chart again, but we've got those really notable, at least very short-term bearish divergences, which of course could get burned through real easy, particularly on some weak inflation data if that's what happens this next week. On the one-year daily chart, you can see quite the bounce back here. Yeah, I think you could legitimately say that looks like a bull flag pattern, and that's about as far as she would go. It's a very small one there. Now the NASDAQ has definitely a more defined downtrend line off the peak there. Several points there. You can see that you can kind of see a candle went right up against it in there as well. So, 4 or 5 hits and closed right on it, just a little bit below that trend line. So that'll be interesting to see. It did recapture that all-important 20-day moving average. Got a pretty good gap there that I'm guessing may get filled. I mean, the technicals would suggest that. You get back up here and you get into this maybe marginal new high territory. I don't think there's any way you're going to get confirmation from the momentum. I guess you could, but it's doubtful the way this looks. So if we get there, it looks like we're going to get there with some pretty ominous looking bearish divergences. Yields. Remember, we were looking at a nice ramp there. Technicals have been working pretty well on yields. We talked about how they look like they could roll over. Momentum was waning. They certainly have. That was very bullish for stocks. If this is going to flag down, yields are going to go down further. That would be weak retail sales, weak inflation data next week would spawn something like that, and that would be very bullish for stocks, as I said earlier. As for the dollar, remember we had this bull flag that couldn't have played out any better. Textbook, went right to the target, rolled over, looks kind of like a bear flag to me. Broke out below the flag here. If that plays out, dollar's going lower. Sure looks like it would based on these technicals here. We'll look at gold real quick. Remember right up in here, got a little concerned. We even hedged our bet a little bit because gold is a pretty good position for us. And we gapped down. The technicals didn't look so good, but I said right in here, it wouldn't surprise me if we didn't see some buying. That was last week, and sure enough, you can see we had a nice gap up and ended the week nicely higher. Haven't quite filled that gap. That would be resistance, perhaps, right here. Nothing inspiring on the momentum indicators, though, so I think gold's going to be very volatile. I could make a case in both directions. Anyway, longer term, we think we're going to see a world where interest rates may have to be kept at bay and inflation may have to be allowed to run a little bit hotter, which would be a very good scenario for gold for quite some time going forward. But make no mistake, this is a volatile asset class, and would not surprise me to see some of these lower levels get tested before we continue our what we think may be actually a long-term bull market in the yellow metal, as they say. Folks, thank you so much, as always, for watching and listening. Hope you have a wonderful weekend, and I'll be back later next week with the key highlights from our internal market log. Take care. Thanks again. Bye-bye.